So if you spend enough time, looking at corporate earnings, you start to get really comfortable with a certain type of predictability.
Oh yeah, like clockwork, right?
Exactly. I mean, you look at a massive software as a service company, for example. They sell like 100,000 enterprise licenses at a fixed monthly cost.
Right. And the churn rate is modeled down to the 0.1%.
Yeah. The accountants run the spreadsheet and the revenue just prints out. It's clean, it's linear, and it gives Wall Street this illusion of, absolute control over the future.
Which is great until it isn't.
Right. But what happens when you take that rigid, really predictable financial model and just throw it into an environment governed entirely by statistical variance, random number generators, and literally a deck of 52 cards?
Well, you get chaos, or at least you get the illusion of chaos on a quarterly basis.
Yeah, totally.
Because those financial models absolutely fracture. You have analysts trying to force a deterministic framework onto a highly probabilistic business model.
And that tension right there between predictability and probability is exactly what we are exploring today. Welcome to this deep dive.
Glad to be here for this one.
Yeah. Our mission for this session is to completely deconstruct the Q2 2026 earnings call for Las Vegas Sands. That's ticker symbol LVS.
And there's a lot to unpack.
So much. We have parsed through the raw transcript, an hour of executive commentary, the analyst Q&A, and just a mountain of supplemental data.
A literal mountain.
Right. And our goal here is to cut through the panic, translate the highly specific jargon of the mega resort industry, and figure out what the actual mechanics of this quarter mean for you and your portfolio.
Because if you just glanced at the financial news the morning after this print, you saw just a barrage of red arrows.
Yeah, it looked terrible. The headlines screamed earnings miss, the stock took a beating, and the immediate narrative was that the Asian gaming recovery was stalling out.
Which is just, it's a fundamental misread of the actual operational data.
Totally.
What we are looking at here is not a structural breakdown of a business. We are looking at one of the most extreme mathematical anomalies in the history of the Macau gaming market.
Wait, historic?
Historic. Wall Street essentially reacted to a bad run of cards as if it were a permanent destruction of demand.
Okay, let's challenge that right out of the gate, though. Because, as an investor, a miss is a miss, right?
Oh.
The cash either hit the balance sheet or it didn't.
Fair point.
I look at the headline numbers from this transcript, and Las Vegas Sands operates basically in two massive Asian jurisdictions. You have Singapore and Macau.
Right.
In Singapore, Marina Bay Sands generated $689 million in EBITDA for the quarter, which is frankly a staggering figure for one property.
It's massive.
But in Macau, their collective properties generated $430 million in EBITDA. And that $430 million number, it missed consensus estimates, which is what triggered the sell-off.
Exactly.
So before we just blame the cards, how do we justify ignoring a bottom line miss of that magnitude?
Well, we don't ignore it, but we have to, isolate the variable that actually caused it.
Mm-hmm.
And to do that, we have to talk about a concept that just dominated this entire earnings call.
Yeah, management used the word relentlessly.
They really did. The word is hold.
Hold, which, for anyone outside the casino industry, hold just sounds like a banking delay, like a hold on your checking account.
Right, yeah. But it's totally different.
So let's break down the actual mechanics of this for you listening, because it's basically the skeleton key to understanding this entire quarter.
It really is.
In casino operations, the hold percentage is simply the house's win rate. So a player walks into the Venetian Macau, they exchange $1 million for chips. That $1 million is the drop or the volume, right?
Correct.
The hold is the percentage of that drop that the casino actually retains after all the bets are settled and the player cashes out whatever is left.
And this right here is where the conflict between Wall Street modeling and casino reality actually happens. Well, every single game on that floor, but especially Baccarat, which absolutely dominates the Asian VIP market, has a theoretical hold.
Okay.
It's an immutable law of mathematics governed by the rules of the game. Over 1 million hands, the casino knows precisely what percentage of the money wagered they're going to keep.
Because the math dictates a house edge.
Exactly.
Yeah.
It is inescapable over a long enough timeline.
Right. But the key phrase there is over 1 million hands. Because Wall Street analysts, they evaluate these companies in strict 90-day windows.
90 days. Yeah.
And in a 90-day window, the law of large numbers hasn't necessarily taken effect yet. Statistical variance can absolutely swing the pendulum in favor of the player.
Precisely. So the theoretical hold is a long-term guarantee, but the actual hold in any given quarter is, well, it's a volatile reality.
Yeah.
And in Q2 2026, Las Vegas Sands experienced a negative variance event of just historic proportions.
It was wild.
Management disclosed that their VIP rolling hold in Macau came in at just 1.35% for the entire quarter.
Okay, I have to stop you there. I understand variance, but 1.35% sounds, I don't know, suspiciously low.
It does sound crazy.
Right. For context, management noted on the call that the normalized expected hold for this specific VIP rolling segment usually models out between like 2.85% and 3.3%.
Right, that's the baseline.
So my question to you is, how does a multi-billion-dollar operation miss its mathematical expectation by that wide of a margin? I mean, is it possible their risk management failed, or maybe they were taken by advantage players?
You know, it's a very fair question to ask when you see a deviation that large. But the mechanics of baccarat make advantage play like card counting and blackjack, for example, virtually impossible to execute at scale.
Because there's no decision-making, right?
Exactly. The drawing rules in baccarat are fixed. The player makes no strategic decisions after the bet is placed. It is purely a game of chance.
Wow.
So what you are seeing with a 1.35% hold is simply the extreme end of the bell curve.
So the whales just got incredibly lucky.
Beyond lucky. I mean, the highest betting, most capitalized individuals in the world walked into Sands properties, placed massive wagers over the course of 3 months, and the cards systematically fell in their favor to a degree the market has basically never seen.
That is insane.
Yeah, the CEO stated explicitly on the call that this was the largest hold adjustment in the history of the Macau market. The house didn't just get beat, they got historically decimated on the math.
Okay, so let's run the what-if math for the listener, because this is where the investment thesis completely flips.
Oh, absolutely.
If you are analyzing a company, you have to separate luck from execution. The transcript lays out the theoretical math perfectly.
Yeah, they mapped it all out.
If luck had just been average, not good luck, just the normal 2.85 to 3.3% theoretical hold, what does this quarter actually look like?
It looks like a massive beat. I mean, if the hold had just normalized, Macau's EBITDA would have been $87 million higher.
87 million, poof, just vaporized by a statistical anomaly.
Exactly. Macau EBITDA would have printed at $517 million instead of $430 million.
Unbelievable.
And the cascading effect of that normalized math on the top-line growth narrative is even more profound. Management pointed out that their total gross gaming revenue, or GGR, in Macau grew by 4% year over year.
Which is a respectable number, sure.
Right, but perhaps uninspiring to a growth-hungry market. However, if luck was merely average, that GGR growth would have been 14%.
14%. That is a staggering divergence. I mean, a 4% growth rate gets you labeled as a mature, sluggish value stock.
Yep.
But a 14% growth rate gets you a premium multiple. And the only difference between those two realities is, what, the random sequence of playing cards over a 90-day period.
Literally just the cards. And we should note, this wasn't purely isolated to Macau.
Oh, right, Singapore.
Yeah, the transcript reveals that Marina Bay Sands in Singapore, despite generating that unbelievable $689 million in EBITDA, also suffered a significant hit from low hold.
Wait, really? Even with that massive number?
Yeah. The volatility there cost them roughly $37 million on the bottom line.
Yeah.
So across the entire enterprise, you have well over $100 million in pure profit, just masked by a temporary mathematical swing.
I want to frame this with an analogy for you listening, because I think it perfectly isolates why selling the stock based on this specific miss is just fundamentally flawed logic.
Let's hear it.
Imagine I offer you a coin flipping proposition. I have a custom coin, and it is weighted. It lands on heads 55% of the time, and it lands on tails 45% of the time.
Okay.
We agree to get $1,000 a flip. I take heads, you take tails. Structurally, my underlying business of flipping this coin is a guaranteed wealth generator. Over 10,000 flips, I am mathematically guaranteed to take your money.
Because the house edge is longed in.
Exactly. But let's say we sit down for our first 10 flips. And through pure, unadulterated luck, the coin lands on tails 8 times. You win $8,000. You feel like a genius.
I'd take that.
Right. Now imagine a Wall Street analyst is standing behind us with a clipboard watching this happen. They look at the results of those 10 flips, they see me down $8,000, and they immediately write a research note downgrading my coin flipping business, claiming my model is broken and I'm bleeding cash.
Which is completely irrational, because the structural reality of the 55% coin hasn't changed at all.
Everything changed.
The analyst is just letting a tiny short-term sample size override the fundamental mechanics of the system.
Yes. The math will eventually, inevitably, revert to the mean. The casino is essentially operating millions of these weighted coin flips every single day.
Right.
So if you are looking at LVS as a potential investment, you should actively want the casino to have a quarter of bad luck.
Because it creates a temporary mispricing.
Exactly. The market panics over the 8 tails, the stock drops, and you get a cheaper entry point into a machine that is fundamentally rigged to win over the long term.
And there is a fascinating psychological layer to this that management brought up on the call.
Oh yeah, the marketing aspect.
Yeah. The casino industry doesn't actually view a low-hold quarter as a complete disaster. In fact, they view it as a form of ultra-effective deferred marketing.
Right. The CEO had a great quote about this. He said, the gate of luck swings both ways. But he also alluded to the idea that when these massive VIPs come in and win millions of dollars, it creates a powerful psychological anchor.
It absolutely does. I mean, think about the mindset of a multimillionaire who just beat the Venetian for a massive sum. They feel triumphant.
They feel invincible.
Exactly. They have this deeply positive emotional bond with that specific property now. So they fly back home, they tell their peers about their incredible run and what is the inevitable result.
They come back.
They come back, they bring their friends, they play bigger the next time, they have supreme confidence. But the 55% coin is still waiting for them.
It's just sitting there.
Right. The house edge doesn't disappear, it just waits. So the millions they won this quarter will almost certainly be recaptured in subsequent quarters, along with new volume generated by their totally positive experience.
It's essentially a customer acquisition cost that pays for itself.
Precisely.
But this brings up a critical counterargument. Let's say I accept your premise. The 1.35% hold is just bad luck, the math will revert, and the business model is totally fine.
Okay.
As an investor, my next logical question has to be, well, was anyone actually flipping the coin? If the win rate was low, that's fine. But if the volume of money being wagered is shrinking, then we have a real structural demand problem.
A very valid concern.
Right. I mean, a 55% weighted coin is worthless if nobody wants to bet on it.
And this is exactly where we move past the headline myths and dig into the actual physical realities of the casino floor during the quarter.
Let's do it.
If we strip away the hold percentage and just look at the raw volume, like the sheer amount of capital being put at risk by players, the narrative flips entirely.
Completely.
The underlying business isn't just stable, it is accelerating at a highly aggressive pace.
Let's lay out the evidence for that, because this is the data that completely contradicts all the bearish sentiment out there. How much money were people actually pushing across the tables?
In Macau, the VIP rolling volume, which is the total aggregate amount of non-negotiable chips purchased by their absolute highest tier players, was up a staggering 73% year over year.
Wait, 73%?
73%.
I want to pause on that because that is not a normal growth rate for a mature asset. We are talking about the highest margin, most exclusive segment of the entire casino ecosystem, and they nearly double the throughput.
It's incredible. And it wasn't just an isolated spike at the top either. The momentum carried through every segment of the floor.
Okay, what about the mass market?
So the Macau mass table drop, which represents the cash exchange for chicks by your everyday premium mass and mass market players, was up 15%.
Also huge.
And the slot machine and electronic table games handle was up 30%.
So let's synthesize that. Every single physical segment of the business, the whales and the private salons, the premium mass players on the main floor, and the slot players, all of them saw massive double-digit increases in the volume of money they were betting.
Across the board.
The weighted coin is being flipped faster and with more money on the line than ever before. They just happened to hit tails this quarter.
Precisely. And this massive influx of volume isn't an accident. We have to look at the mechanical how behind these numbers.
Right, because you don't just magically get 73% more VIP action.
Exactly. How do you generate 73% volume growth in the VIP segment? It requires a relentless execution of capital allocation. Management has spent the last several years completely overhauling their physical product.
Renovations.
Right. They poured billions into upgrading the Londoner Grand, the Londoner Court, and the Grand Suites at the Four Seasons. And they didn't just put fresh paint on the walls.
No, this was a structural thing.
They fundamentally redesigned these spaces to cater to a new, ultra-demanding tier of Asian wealth. They built bespoke environments that physically compel high-net-worth individuals to consolidate their play at Sands properties. The 73% growth basically proves that this capital allocation strategy is yielding massive returns.
But wait, let's address the massive glaring anomaly that hit this volume right at the end of the quarter. Because while the 90-day volume numbers were incredible, management felt compelled to explicitly warn analysts about a bizarre drop-off in traffic in June.
Yes, the June drop-off.
And this is something that a purely quantitative financial model simply cannot predict or account for.
The World Cup disruption.
Yes. I find this absolutely fascinating. Explain the mechanics of this to the listener. What happened in June of 2026 that caused the management of an Asian casino empire to essentially say, well, our best players just vanished for a month?
It's a perfect case study in how global macro culture intersects with high-end luxury consumption. On the call, executives pointed out that in June, they experienced a sharp, undeniable decrease in visitation from their top-tier patrons in both Macau and Singapore.
And the reason?
The 2026 FIFA World Cup was being hosted in the United States.
So the whales literally packed up and left Asia.
They did. You have to understand the demographic of a modern mega casino VIP. These are not localized gamblers, right? They are ultra-wealthy global citizens.
Right. They have houses everywhere.
Exactly. They own real estate in London, family offices in Singapore, businesses in Shanghai. And European football has an absolutely massive cultural footprint among the Asian elite.
Oh, massive.
So the World Cup in the U.S. was positioned as this unprecedented global spectacle. Massive infrastructure, unparalleled VIP hospitality, global networking. If you are a billionaire from Jakarta or Beijing, and you are looking for premium entertainment in June of 2026, you are boarding your Gulfstream and flying to Miami, Los Angeles, or New York to watch the matches from a $500,000 luxury suite.
You are not sitting at a baccarat table in Macau.
Exactly. You are gone.
It's incredible. And it really highlights the absurdity of how Wall Street analysts operate sometimes. I mean, you have these highly educated quants in Manhattan building incredibly dense algorithmic models to predict the exact cash flow of a casino in Singapore.
And the model breaks.
Yeah, and the stock gets hammered because a few hundred billionaires decided they'd rather watch soccer in America for 4 weeks. It proves that you cannot model high-end global tourism in a sterile vacuum. Cultural gravity actually matters.
It absolutely matters. And you could hear the frustration from the analysts on the call trying to quantify it.
Oh, I'm sure.
They were peppering management with questions like, is this a structural slowdown in the Chinese economy? Have the VIPs permanently changed their behavior? Are we seeing a bounce back now that the tournament is over?
And the CEO's response was so revealing, wasn't it? He basically had to stop them and say, look, the final match was on Sunday. It's Wednesday. The tournament ended 72 hours ago. They are probably still on their private jets flying over the Pacific. Just give it a minute.
It's the epitome of short-termism. The market demands instant data verification for a demographic that operates on its entirely own timeline.
But here is the most critical point about the World Cup disruption. Despite the fact that their best players physically left the continent in June, and despite the historically bad luck at the tables, look at what Las Vegas Sands actually achieved in Macau over the full 90 days.
The market share.
Yes, because this specific data point is the definitive proof of their operational dominance.
You are referring to the market share capture, and you're right. This is arguably the most vital piece of fundamental data in the entire transcript.
Yeah.
Despite all those headwinds, Las Vegas Sands achieved a market-leading 26% share of the entire VIP rolling volume in Macau.
26%. They captured over a quarter of the most lucrative, highly contested market segment in the world.
And context is everything here. On the call, the president of Sands China laid out a timeline that should frankly terrify their competitors.
Yeah.
He noted that just 1 year ago, Las Vegas Sands was sitting at number 4 in the Macau VIP segment, number 4 out of the 6 concessionaires.
Wow.
And in just 12 months, they leaped over everyone to become the undisputed number 1 player in the market.
I want to push on how mechanically difficult that actually is. Because if you are a retail business, gaining market share might just mean, lowering prices or running a better ad campaign.
Sure.
But in the ultra VIP casino space, customers are incredibly sticky. They are creatures of habit. A whale who plays at Wynn or MGM has a dedicated host they've known for years. They have a specific private salon they like, a specific suite they stay in, specific credit lines already established.
It's all very entrenched.
Right. The friction required to move a player from one property to another is immense. So to rip 26% market share away from established competitors and go from worst to first in 12 months, How do they actually do it? Are they just overspending on marketing and buying the business?
That's the exact question analysts asked. And management's answer revealed a highly disciplined, three-pronged strategy they call people, product, and service.
Okay.
So no, they aren't just blindly throwing promotional money at players. They executed a structural upgrade of the entire VIP experience.
Break that down.
First, the product. We talked about the billions spent renovating the Londoner and the Four Seasons suites. They physically built superior environments.
Right.
Second, the people and service. They intentionally inflated their operating expenses over the past year to flood the zone with high-touch service.
Flood the zone how?
They added table operating hours, so private games are always available. They massively increased their sales and marketing headcount, poaching top-tier hosts who basically brought their books of business with them.
Ah, so they brought the players with them.
Exactly. And they retrained the entire staff to execute at a level that caters to the absolute pinnacle of global wealth.
So they essentially built a better mousetrap, staffed it with the best people, and the whales predictably migrated. It's an incredible execution of operational leverage.
Which brings us to the forward-looking aspect of this deep dive.
Right.
We've established that the quarter was a mathematical illusion. The luck was historically bad. The best players temporarily left for a sporting event, but the underlying volume and market share are surging.
Surging.
So how is management reacting to this temporary mismatch between their stock price and their operational reality? Are they retreating? Are they cutting costs to appease the analysts who are, crying about earnings miss?
Not even slightly. In fact, if you look at their capital allocation, they are doing the exact opposite. They are leaning into the variance. They are doubling down on luxury. And more importantly, they're doubling down on themselves.
The buybacks.
Yes, let's talk about the ultimate corporate flex, the share buyback.
When a management team intimately understands the mechanics of their own business, when they know the 1.35% hold is just noise and the 73% volume growth is the reality, and they see the market indiscriminately selling off their stock, the most rational, accretive thing they can do is buy their own shares.
Buy the dip.
Exactly. And Las Vegas Sands is executing this strategy with staggering aggression.
Let's give the listener the raw numbers because they are massive. In this quarter alone, despite the earnings miss, management repurchased $787 million of LVS stock.
Nearly $800 million.
Yeah, $800 million deployed in 90 days just to vacuum up their own shares from panicking institutional investors.
And that is just the tip of the spear. If you zoom out and look at their sustained capital return program, the transcript notes that over the last 11 quarters, they have repurchased 16.3% of the company's entire outstanding share count.
16.3%.
They have systematically retired nearly 1/6 of the entire company.
Let's explain why this matters mechanically to you, the listener, if you happen to hold this stock. A share buyback isn't just corporate window dressing, right? It alters the fundamental mathematics of your ownership.
Absolutely.
If you own 100 shares of LVS and the company permanently retires 16% of all the other shares in existence, your 100 shares suddenly represent a significantly larger percentage of the total company.
Your slice of the pie gets bigger.
Yes. Your claim on all future earnings, all future dividends, and all future cash flows mathematically increases, and you didn't have to spend a single dime of your own money to get it.
Exactly. It financially engineers earnings per share growth, even if top-line revenue stays flat.
Right.
But of course, their revenue isn't flat.
Yeah.
And the aggression is accelerating. On the call, the CEO announced that the board of directors just authorized a brand new $6 billion share repurchase program.
$6 billion.
$6 billion. He stated directly that they see meaningful value in the current equity price and believe these repurchases will be highly accretive over the long term.
But let me play devil's advocate here for a second. I hear $6 billion share buyback, and a part of me wonders, is this a signal that they've run out of ideas?
The classic argument.
Right, because usually when a company transitions from aggressive expansion to massive buybacks, it means they have nowhere left to deploy capital at a high rate of return. Are they just financially engineering the stock because the growth story is basically dead?
That is a classic capital allocation debate, but in the context of LVS, the argument just doesn't hold up. They aren't buying back stock because they lack growth opportunities. They are buying it back because the market is offering them a deeply discounted rate on their own proven cash flows.
Okay, that makes sense.
The return on invested capital for buying their own stock at these depressed multiples is simply higher and less risky than trying to break ground on a brand new, unproven jurisdiction.
And we know they aren't abandoning internal investment because the transcript details a massive forward pipeline of capital expenditures.
Huge pipeline.
But before we get to the physical building, we have to address the other side of the ledger, the operating expenses. Because if you are going to buy back billions in stock, you have to protect your free cash flow. Analysts on the call were fiercely interrogating management about their OpEx.
Right. And this goes back to how they captured that 26% market share. They spent heavily on hiring, marketing, and table hours. Analysts are naturally terrified of cost inflation. They want to know, is this elevated level of spending permanent? Have margins been structurally degraded just to buy market share?
And how did management answer that? What is the mechanical timeline for these costs?
They provided a very clear, highly reassuring glide path. Management stated that the aggressive investment phase in OpEx, the heavy lifting of hiring and training the Army required to service these new VIPs, is essentially complete.
Oh, wow.
Yeah, they expect those operating expenses to plateau and level off in the second half of 2026.
Which sets up a massive springboard for operating leverage. Let's explain the mechanics of operating leverage, because it is basically the holy grail of casino finance.
It really is.
A mega resort has incredibly high fixed costs. You have to air condition millions of square feet, keep the lights on, and staff the floors, whether there are 10 people in the building or 10,000.
Right, the AC is running either way.
Exactly. But once those fixed costs are covered, almost every incremental dollar of revenue flows straight to the bottom line as pure profit.
Exactly. So if OpEx is strictly leveling off in late 2026, but VIP and mass volume continue to surge, the margin expansion is going to be explosive.
Explosive.
And that mechanical leverage is exactly why management remains fiercely committed to their stated target of $700 million in quarterly EBITDA in Macau alone.
The analysts pushed back on that, right?
Oh, they tried to get them to walk that number back because of the quarter's miss, but the executives absolutely refused. They know the physical capacity and the cost structure are perfectly aligned to hit it once the hold normalizes.
But while the day-to-day operating expenses are plateauing, the long-term physical investment, the CapEx, are accelerating. And this is where the logistics get genuinely fascinating to me.
They are projecting roughly $600 million in capital expenditures for the upcoming year. And the centerpiece of this investment is a massive structural overhaul of what is arguably the most iconic property in their portfolio, the Venetian Macau.
Let's dive into the sheer logistical nightmare of this project because I don't think people comprehend the scale. The Venetian has 2,900 suites. It is a monolithic structure.
It's a city.
It is. But the Asian luxury consumer evolves incredibly fast. What was considered ultra luxury 10 years ago is now just standard.
Exactly.
To defend their market share against brand new properties on the Cotai Strip, those 2,900 rooms need a complete down to the studs refresh. So my question is, how on earth do you renovate a 2,900 room hotel in a casino that operates 24 hours a day without destroying your revenue stream and, alienating your guests with construction noise?
It requires surgical precision, and management detailed a highly phased, methodical approach. They are taking roughly 400 rooms out of inventory at a time per quarter. They isolate a block, strip it down, completely refurbish it to modern ultra-premium standards, and then reintroduce it to the pool before moving to the next block.
So it's a rolling renovation.
Exactly. They began this process in March, and the strategic target is to have the entire 2,900 suite property finished and fully online by Chinese New Year in 2028.
And here is where the concept of a scale moat becomes so apparent. If a standalone casino takes 400 rooms offline, it cripples their capacity.
They're dead in the water.
Right. But because LVS operates a massive interconnected ecosystem on the Cotai Strip, they literally have enclosed walkways connecting the Venetian to the Londoner, the Parisian, and the Four Seasons, they can simply shift their demand.
Seamlessly.
If a guest wants a suite at the Venetian, but that block is under construction, the host just walks them over to a newly renovated suite at the Londoner. They don't lose the customer, they just shift them within their own proprietary ecosystem.
That scale is an insurmountable defensive barrier for smaller operators. And we really need to look at what they're actually building with this CapEx. They aren't just putting in new carpets.
No, definitely not.
The transcript specifically notes they are constructing premium-focused gaming salons and related amenities. They are looking at the data, seeing that they just captured 26% of the VIP market, and they are reverse engineering the physical architecture of the Venetian to build bespoke fortresses explicitly designed to trap and retain that specific demographic.
Okay, so we've systematically deconstructed this earnings call. We've looked at the math of the hold, the staggering volume growth, the World Cup anomaly, the aggressive buybacks, and the logistical realities of their capex.
We covered a lot.
Now it's time to synthesize this data. If you are an investor staring at LVS in your portfolio right now or considering initiating a position, what is the ultimate actionable verdict?
Well, if you aggregate all the underlying mechanical data from this transcript and separate it from the emotional reaction of the broader market, the verdict is undeniably forcefully bullish.
Let's solidify the why for the listener.
The market is fundamentally an expectation machine.
Yeah.
Right? And it frequently misprices assets when it confuses temporary noise with structural decay.
And this quarter was noise.
The narrative that drove the stock down this quarter was built entirely on noise. A 1.35% hold in baccarat is noise. Billionaires flying to Miami in June to watch a soccer tournament is noise.
Right.
Neither of those variables alters the long-term cash flow generation of the enterprise, but the actual underlying mechanics of the business is roaring.
73% growth in VIP volume, a leap from number 4 to number 1 in market share, a $6 billion buyback authorization.
Exactly. And let's not forget Singapore, which we've barely even touched on.
Sure.
Marina Bay Sands generated nearly $700 million in EBITDA in a single quarter, proving that their thesis of building ultra-luxurious integrated resorts yields astronomical returns when fully scaled.
It's a cash machine.
These are the metrics that define the true trajectory of Las Vegas Sands. The underlying business is a coiled spring. If the baccarat math had simply been average, if the coin landed on heads just 55% of the time like it's programmed to do, they generate an additional $87 million in Macau without changing a single operational variable.
And that is the actionable takeaway for you, the listener. The market has basically handed you a classic textbook buy the dip scenario.
The quintessential setup.
The house edge is an immutable law of mathematics. It does not vanish. It merely hides behind short-term variance. When a mega casino loses to a run of lucky cards, the math always swings back.
Always.
If the executive team is so acutely aware of this mispricing that they are deploying $800 million in a single quarter to vacuum up their own shares, you should take a very hard analytical look at aligning your capital with theirs.
With the mighty.
You are essentially being offered a discount on a best-in-class, structurally dominant operator purely because a few billionaires got lucky at the tables for 90 days.
It is the equivalent of buying a highly calibrated money printing press at a 15% discount because it jammed for an afternoon.
I love that analogy.
The internal gears are flawless. It just needs to be reset. And as we look toward the second half of 2026, the catalysts for that reset are perfectly aligned.
Right. OpEx is dropping.
Operating expenses are plateauing. The World Cup is over, meaning the global VIPs are returning to their standard Asian circuits. And management highlighted a massive slate of incoming entertainment programming, including NBA exhibition games and high-profile residencies, designed specifically to drive that premium mass traffic back to the Kodai Strip.
It is a setup for a massive reversion to the mean. But before we close out this deep dive, I want to pivot and leave you with a broader macroeconomic concept to chew on.
Do it.
We've spent the last hour dissecting the micromechanics of baccarat win rates, room renovations, and share repurchases. But there was a specific phrase that management dropped during their discussion of the Singapore market that completely reframed how I look at this entire company.
Well, the wealth creation quote.
Yes. They explicitly cited the wealth creation in Southeast Asia as the fundamental driver of their long-term growth.
Yeah, they were highlighting the demographic and economic explosion happening right in their backyard, the influx of foreign direct investment, the rapid rise of young, tech-savvy entrepreneurs, and the compounding multi-generational wealth happening across the region.
Right. And it made me stop and reconsider the entire categorization of this stock. Wall Street meticulously groups Las Vegas Sands into the gaming sector.
Always.
It sits in the consumer discretionary bucket on your brokerage app, right next to cruise lines, hotel chains, and theme parks. But ask yourself this, are modern mega resorts like Marina Bay Sands actually just gaming stocks anymore?
I'd argue no.
Or have they evolved into something much larger? Are they, in fact, the most direct, liquid, and efficient financial instrument available to invest in the explosive, unprecedented growth of the new Asian upper class?
It is a profound way to look at the asset. If you are a macro investor and you firmly believe in the economic ascendancy of Southeast Asia, if you look at the data and see that thousands of new millionaires are being minted across Jakarta, Manila, Ho Chi Minh City, and Mumbai every single year, the question becomes, how do you reliably capture the upside of that wealth creation?
Exactly. You could try to pick individual local equities in emerging markets, right?
Yeah.
But that exposes you to massive regulatory and currency risks.
Massive risk. Or you could simply buy the company that owns and operates the absolute pinnacle luxury destination where all of those newly minted millionaires inevitably travel to send their capital, display their success, and network with their peers.
Exactly. Marina Bay Sands isn't just a building with tables and slot machines. It operates as the cultural, social, and financial nexus point for the wealthiest demographic in the fastest growing economic region on Earth.
It's the hub.
Singapore acts as the safe haven capital hub of Asia, and Marina Bay Sands is the epicenter of that hub. When you buy shares of LVS, you aren't just betting on whether a baccarat player draws a natural nine. You are essentially taking a structural royalty on the broader economic expansion of the Asian continent.
And when you zoom out and view the company through that macroeconomic lens, the day-to-day volatility of a 1.35% hold percentage seems incredibly trivial.
It's totally meaningless.
The quarterly fluctuations of a card game are irrelevant when you realize you own a proprietary toll bridge to the future of global wealth.
I couldn't agree more. If you confine your analysis to the surface, if you demand that every company behaves like a predictable software spreadsheet, you are going to look at Las Vegas Sands and see a messy, volatile, muddy picture.
And you'll panic.
You will panic at the variance and sell at the exact wrong time. But if you take the time to look deeper, to understand the mechanics of the rigged coin, the structural dominance of their market share, and the undeniable macro tailwinds of Asian wealth creation, well, the muddy waters clear up instantly.
The volatility is just a mirage. The underlying foundation is built on impenetrable mathematics and irreplaceable real estate.
And that is exactly why you have to look past the headline numbers. Thank you for joining us on this deep dive into Las Vegas Sands. Remember, the math always reverts to the mean, and over a long enough timeline, the house always wins. We'll see you next time.